Treasury yields held onto their lows a day after the Federal Reserve put out a pretty dovish statement after their Fed meeting suggesting that rates are on hold at least for the end of 19 with the possibility of a cut coming before the next tightening. And the market right now still sort of reacting to what we heard yesterday, reacting on a positioning perspective as well as a technical one, and the market breaking out of the range, the 260 to 280 yield range we've seen for most of this year, and trading down to 2.5%, actually a tick just below it, suggests that we may have some more downside in yield, upside in price, with the idea that there could be some more flight to quality bids. There could be perhaps some hedging needs. The leverage community remains very, very short treasuries at this point. Could be hedges against other positions, but as we got, made the moves away from 3%, it seemed they were continuing to add to shorts. So a lot of those shorts may be stale. A lot of those shorts may be part of the reason why we saw that big push yesterday. Today we did see yields kind of sustain and not continue to see that movement. So 2.5 seems to be the magnet, at least for now. We'll have to wait and get the data, see how things react to Brexit later on this month or possibly in May if they are able to push it down the line. Likewise, any deals with China and equities could be a big play in this as well. With equities sitting on the highs, any sort of crack in that would certainly add to the bond buying that we've seen here over the last, not only in the last 24 hours, but certainly over the last, call it 3 months. And with Treasury yields so low already, how much lower can they go? And I think that how low can they go? Well, you can probably see them get down to 230. There's some speculating we could trade yields below 2%. And I think that's a bit of that's a reach at this point. But certainly all options are on the table as the market is sort of broken out of the range to the downside, when I think all expectations were we would see yields go higher with a Fed that was tightening, with an economy that was expanding, and things have kind of gone the other way. And if you look at market volatility after you break out of the range or nearing any point where you're going to break out of the range tends to bid. We did not see that. Actually, volatility remains very close to year-to-date lows. I think when you add in more Fed, you get lower volatility. Obviously, the Fed saying they're going to stop with some of their balance sheet unwind, saying they're going to keep rates where they are is sort of a signal to the market, and that will obviously cause yields to not go up anymore, at least. We didn't expect them to go down this quickly, but I think that is part of it, is that the Fed injection lowers volatility. If you go back over the last decade, when we saw the Fed holding rates at 0%, that's what volatility did. It hovered at 0. So right now, low vol, low yields. And if you look at some of those curves, what are they really telling you? 10-year got below 2.5% for a spell overnight, bringing the 10-year to effective rate below 10 basis points. Well, you saw the 7-year trade below the effective rate of 240. You saw the 5 and 3-year do it, not only overnight and yesterday, but actually going back to last week. So this inversion in the middle part of the curve is starting to cause some concerns. I'm not sure this is going to be a signal for a recession, but certainly it makes you scratch your head as to why those particular buckets are seeing yields decline so much quicker than, say, in the 2-year or the 30-year bucket, albeit the 30-year bucket seeing yields below 3%. But I think that at this point right now, you're going to see a lot of confusion trade, what it really means. Obviously, demand in those sectors is what's driving the market, and that could push yields even lower if things don't improve or we don't get some kind of improvement quickly. So right now, yield curves at their flattest we've seen in a long time, with certain 3s, 5s, and 7s actually marking below the Fed effective, with 10-year note yields hovering at 2.5%. How much lower can they go?